how one client went from almost signing the wrong mortgage to being mortgage-free 16 years ahead of time. Now, here's how it started. This is the story of how one client almost signed the wrong mortgage to being mortgage-free 16 years faster. This client, let's call him Stan. He came to me because he was buying a new home. He had already been approved by a bank. Pretty good rate, conditions waived, and the closing date was locked in. On paper, everything was sorted. The problem was the mortgage product. His bank product only allowed a lump sum prepayment once a year, no readvanceable component. And while it offered a line of credit, he didn't know well enough to ask for it to be readvancing, and the lender didn't really offer it. And so for most people, that's fine. He got what he asked for. And it wasn't really a deal breaker. But without the right product, we couldn't run a strategy. And without the strategy, he was just going to spend the next 25 or 30 years paying down a mortgage the expensive way. But you are going to leave a significant amount of money on the table by staying with this product. It doesn't matter if the rate was lower, the strategy will outperform it considerably. He trusted that. And then he mentioned something that changed everything. He was keeping his original home and turning it into a rental property. And that's when I sent him the cash damming video that I've created. He watched it. He called me back and said, "This makes complete sense. This is exactly what we want to do." So let me walk you through what this situation actually looked like and what we built around it. Stan is buying a new primary residence for about $525,000, and he's putting about 20% down, which gives him a mortgage of roughly $420,000. His closing date is in August, so we have time to set everything up properly. His rental property, his original home, has no mortgage on it. It's free and clear, and it's going to generate about $1,800 a month in rental income. Now, here's where most people stop and say, great, that's just extra income. Let that sit in the account, cover whatever expenses come up, and enjoy the surplus. But that's not what we're doing. Here's what the cash flow dam does. Every single month, that $1,800 in rental income goes directly into Stan's primary residence mortgage as a prepayment on top of his regular mortgage payment. Because we're going to set him up with a readvanceable mortgage, one with a built-in HELOC, that $1,800 prepayment immediately creates $1,800 of available room on his line of credit. He then borrows whatever his rental expenses are from the HELOC to cover them. Because those borrowed funds are being used to service an income-producing property, the interest on that line of credit is going to be tax deductible. So his primary mortgage is being hammered down every single month. His rental expenses are still covered, and the interest he's carrying is working for him instead of against him. Now, Stan's situation has an extra wrinkle that makes it even more powerful. Because he has no mortgage on his rental property, he has something most landlords don't: the ability to absorb and move the debt strategically. Here's what I mean. As the HELOC balance builds up over time, covering the rental expenses, Stan can refinance his rental property, which has significant equity and no existing debt, and use those funds to pay the HELOC balance. He's essentially moving the debt from his primary residence to his rental property legally, which is exactly where you want it: investment property debt, potentially tax deductible, working for him. He gets to do this every few years, move that debt over, keep the primary mortgage converting faster, keep the tax efficiencies building. So what does this full picture look like? Well, $420,000 primary mortgage, $1,800 a month in rental income on a prepayment added via cash flow dam, plus his regular mortgage payment. Without the rental cash damming strategy, Stan will pay down his $420,000 mortgage over the standard amortization. He's going to be mortgage free in 25 years. He's paid a significant amount of interest along the way. Now, with the cash flow dam strategy, that $1,800 that's hitting his mortgage every single month on top of his regular mortgage payment, it's accelerating the pay down dramatically. This means mortgage freedom in approximately 14 years, not 25, not 30, 14, and without changing any of his original cash flow, not taking anything out of his pocket, just simply applying the rental income to his mortgage as a prepayment. That will drive down his non-deductible mortgage debt very quickly. And the tax savings generated along the way from deducting the interest from his line of credit, those can be reinvested, put back onto the mortgage, or deployed in a broader wealth strategy as Stan's confidence and comfort with the approach grows. And then he asked the question I love. He says, "Can I do this with more than one rental property?" Yes, absolutely. In fact, and here's what that actually looks like. Stan's rental property has no mortgage on it. So we can refinance the mortgage on his rental property, use that money as the down payment for his next property. And because he's used it to buy a rental property, the interest on that debt is automatically tax deductible. unbelievable. And now he's going to have 2 rental incomes hitting his primary mortgage every single month. The paydown accelerates even further. The debt conversion happens even faster. And none of it required him to pull any money out of his own pocket because the strategy funds itself. That's not a pitch. That's just math structured correctly. Stan almost signed a mortgage with a bank that would have locked him into a product that could support any of this. He would have had a fine rate and 25 to 30 years worth of payments ahead of him. He's looking at 14 years, saving hundreds of thousands of dollars. And his rental property is actively accelerating his primary mortgage paydown, a growing tax efficiency in his debt structure, and a clear path to a second rental property funded entirely by the strategy itself. The difference wasn't his income. It wasn't the rate. It wasn't even the property. It was structure. It was strategy. So if you own a rental property, or if you've been thinking about converting your current home into one and you want to understand what this could look like in your specific situation, that's exactly what I'm here for. Book a call using the link below and let's chat. And don't forget to share this video with your friend because everybody knows a landlord and this is powerful stuff for them. Don't forget to stick around. There's a lot more to come about how to make your mortgage work smarter so you don't have to work harder. Mortgage Free with Erica V.